Assalamu alaikum. Dear student, in the previous class we stopped at how to convert a real rate to the nominal or nominal to the real by using Fissure effect. Let's try one or two more question on that area, and then inshallah we'll proceed further in NPV topic. So by using Fissure effect, you can convert real cost of capital to the nominal cost of capital or nominal to the real. It depends on the question. Assuming real rate is 10%. Inflation rate is 5%. You just need to calculate the nominal rate. By using Fissure effect, we can easily convert real rate to the nominal or nominal to the real by using a formula. The formula is nominal rate, that is 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. In Fissure effect, the inflation rate which we use, that is a general inflation, which is overall in the economy. We do not use a specific inflation. A specific inflation means if I say, let's say the selling price will increase by 10% and variable cost will increase by 5% and the fixed cost will increase by, let's say, 8%. All these three are examples of specific inflation. In Fissure effect, actually, we use a general inflation. And nothing is mentioned whenever you have given an information to convert real rate to the nominal, then like in this question, you will always assume that given inflation rate is a general inflation rate. So let's try to calculate nominal rate. The real rate is 10%, it means it becomes 1.1 because 1 plus real rate is 10%. You will be writing this 10% can be written like 0.1. Inflation rate is 5%, so 1 plus 0.05. So into 1.05 minus 1. So here comes the answer. Must be higher than 15%. 1.1 into 1.05 minus 1, I'm getting 15.5%. So simply the nominal rate is 15.5%. So by using Fissure effect, obviously it depends on the question. For example, in the question you have been given all the nominal cash flows, but examiner has, let's say, given you the real cost of capital. Then obviously you have to use the Fissure effect to convert a real cost of capital to the nominal cost of capital. So that is all about cash flows. We did discuss in the previous class, there are two types of cash flows. One is real cash flow, another is nominal cash flow. For real cash flows, the discount factor has to be real. For nominal, the discount factor must be nominal. Now let us discuss one extremely important concept. The name of the concept is, which concept we are discussing right now? Actually, when it is necessary to calculate NPV in nominal terms. Repeat, my question is, when it is necessary to calculate NPV in nominal terms. Let us understand this with the help of an example. Then I'll give you the answer when it becomes necessary to calculate NPV in nominal terms. Assuming, just let's take an example, T1, T2. Let's say we have cash flows 100 and 200. Assuming the discount factor is 10%, it is 10%. So when the discount factor cost of capital is 10% in the first year, it is 0.909. Second year, it is 0.826. Simply multiply this. Present value of net cash flow. I'll get 90.9. 200 multiplied by 0.826. We are getting 165.2. Okay. Now the same example. It is T1, T2. Cash flows are 100 and 200. Now let's incorporate inflation into these cash flows. Assuming inflation rate is 5% per annum. Inflation is 5% per annum. So if I multiply this with 1.05, let's multiply this with 1.05 with the power 2. So it becomes 105. 200 into 1.05 power 2. I'm getting 220.5. Obviously, after incorporating inflation to the cash flows, now you have nominal cash flows. Now listen and listen carefully. When your cash flows are nominal, then your discount factor has to be nominal. Repeat, when your cash flows are nominal, then your discount factor must be nominal. It is the same question, 100 and 200. What I did, I have just incorporated 5% inflation into this 100. It means the given 100 is a real cash flow. Now we have converted this into the nominal, which is 105. 200 is in real terms, we have converted into the nominal. Since now the cash flow 105, 220.5, they are in nominal terms. So we need a cost of capital. It has to be in nominal terms. It means that this 10%, actually it is a real cost of capital, because the same cash flows I've taken and I've incorporated the inflation into these cash flows. Since it means 100 and 200, they are real cash flows. After incorporating the inflation, they have become nominal. So let's incorporate 5% inflation to this 10% discount factor to make it nominal. So simply the nominal rate will be 1.1 into 1.05 minus 1. It's going to be 15.5%. So it means the nominal discount rate, nominal discount factor, discount rate is 15.5%. So now we need to find out the discount factor at 15.5%. Discount factor of T1, how will you calculate? 1.155 minus 1. 1.155 power is minus 1. So discount factor of T1 is 0.86, you can say 58. Discount factor of year second year, 1.155 minus 2. 1.155 minus 2. I'm getting 0.7496. Okay. So in the first year, it is 0.8658. For the second year, it is 0.7496. Now let us multiply to get the present value. 105 multiplied by 0.8658. I'm getting 90.9. 220.5 into 0.7496. I'm getting 165.2. Look at this. The present value is 90.9. The same present value is coming here. Present value is 165.2. It is 165.2. A very important concept. If we have a single inflation rate, whenever you have been given a single inflation rate, then either you are calculating present values in real terms or nominal terms. You will have the same present value. It means the concept is when there's a single inflation rate, then you are calculating, let's say, NPV in real terms or nominal terms. It makes no difference because NPV will be same. Repeat, you can see over here. This is in real terms. Present value, you can see this. Now we have nominal cash flows and you can see the present values. So the concept is when there's a single inflation rate, either you are calculating NPV in real terms or nominal terms, it will be same. It means that if you come across a question where you have more than one inflation rate, then it is compulsory to calculate NPV in nominal terms. But when there's a single inflation rate, then it is not compulsory to calculate NPV in nominal terms, because when there's a single inflation rate, then NPV will be same in real terms as well as in nominal terms. So the concept is, when you have more than one inflation rate, then it becomes compulsory to calculate NPV in nominal terms. And let me just write a formula. How do we calculate the discount factor of different years? Discount factor is equal to 1 plus R, and the power is minus 1. Basically, the R is the cost of capital. For example, if the cost of capital is, let's say, 10%, and you need to calculate discount factor of the first year, what will you do? Discount factor of T1, 1.1 minus 1, it gives you 0.909. Discount factor of T2, 1.1 minus 2, it gives you 0.826. Obviously, when we'll be, inshallah, doing complete questions on Excel, you don't need these discount factors. The shortcut of NPV is available. By using that shortcut, you can directly calculate NPV. How do we apply that shortcut? We'll discuss, don't worry at all. So discount factor of T3. So this is how we calculate discount factor of different years. Okay, now let's move. I think it was in the second class when we discussed that when we are working in when we are working for NPV, then one of the basic principles says that you have to incorporate only cash flows. By definition, each and everything must be cash flow except the tax depreciation. Actually, the tax depreciation itself, it is not a cash outflow, but what happens due to tax depreciation, actually we save tax. That is why what do? We consider tax depreciation. Another name for the tax depreciation is capital allowances. So let us now try to learn how do we calculate tax saving from the capital allowances. Repeat. How do we calculate tax savings from capital allowances? Capital allowances is another name for the tax depreciation. Initial investment is, let's say, 200,000. Residual value is 50,000. Project life is, let's say, 4 years. Company uses 25% written down value method for capital allowances. Tax rate is 30%, which is paid with a delay of 1 year. We are not paying the tax in the same year. We are paying the tax with a delay of 1 year. It means tax of T1 will be paid in T2 and tax of T2 will be paid in T3. Okay. Required. Calculate tax savings from capital allowances. Assuming investment is made at the start of accounting period. Assuming investment is made at the start of accounting period. In financial management, 99%, I would say 99% of the question will be set when the investment is made at the start of accounting period. Now you might be thinking, what is the importance of writing this, that the investment is made at the start of accounting period? Another question comes in some of the students' mind, that what if the investment is not made at the start of accounting period? If it is made at the end of accounting period, then what happens? We will discuss that. Don't worry at all, inshallah. But right now we are discussing the case which 99% comes in your exam. That investment is made at the start of accounting period. Okay. We need to calculate tax saving from capital allowances. How do we calculate? Let's very simple. Time period T1, T2, T3, T4, and T5. Why T5? Even though the project life is 4 years, but its impact will go for T5. Why? Because tax is paid with a delay of 1 year. So that is why instead of restricting ourselves to T4, I have written till T5, because T4 tax will be paid in T5, or in other words, T4 tax actually will be saved in T5. So one column is for the time, second is capital allowances. Capital allowances. Third one is tax savings. It is 25% written down value method means basically that is reducing balance method. In reducing balance method, all you need is just apply that 25% on the cost. So first year, your tax depreciation, your capital allowance will be 25% of 200,000. If I take 25% of 200,000, it will be 50,000. Okay. Now, how do we calculate the capital allowance for the second year? Since it is on reducing balance method, so what do? You will take the cost less the tax depreciation or capital allowance of the first year, then you will be getting a net book value 1,50,000. On this 150, you will apply 25%. If I apply 25% on this 1,50,000, I'm getting 37,500. The shortcut is, instead of calculating net book value each year, you can do one thing. If I take the capital allowance of the previous year into 75%. Since the reducing balance method is 25%, so all you need is just take first year capital allowance, multiply this with a 0.75. What if we had capital allowance by using 20% tax depreciation, 20% written down value, then whatever the tax depreciation comes in the first year, whatever the capital allowance comes in the first year, for second year, I would have multiplied that with 0.8. Over here, the tax depreciation is 25%. The shortcut is first year capital allowance will be multiplied by 75% in the next year. So if you multiply 50,000 with 0.75, obviously you will get the same thing, 37,500. For the third year, take 37,500 into 0.75. Let's see what I'm getting. I'm getting 28,125. Now listen and listen carefully. The project life is 4 years. The project life is 4 years. So whenever there's a reducing balance method, so in the last year, we always take balancing figure. What is the logic of taking balancing figure? I'll discuss that. Don't worry at all. But with the honesty, you have to write over here balancing figure. How do we calculate balancing figure? What is the logic of calculating balancing figure? I'll discuss that. Now let me tell you one thing. According to IAS 16, property, plant and equipment, there's a concept. The name of the concept is IAS 16 says only depreciable cost should be depreciated over the useful life of the asset. Only depreciable cost should be depreciated over the useful life of the asset. Depreciable cost means cost minus residual value. Cost minus scrap value. Repeat. According to IAS 16, only depreciable cost should be depreciated over the useful life of the asset, and depreciable cost is cost minus residual value. So the cost is 200,000 minus the residual value, which is 50,000, it is given in the question. So logically, the depreciable cost is 1,50,000. So always you'll be calculating a balancing figure in the last year. From 1,50,000, you need to deduct 37,500 and minus 28,125 in order to get the balancing figure. 1,50,000 minus 50,000 minus 37,500 minus 28,125. The balancing figure is 34,375. So the balancing figure is 34,375. How did I calculate balancing figure? 34,375. All I did, I have deducted 50,000, 37,500, 28,125 from 1,50,000. Now, how to calculate tax saving? All you need is just multiply capital allowance with the tax rate. You will get the tax saving. Repeat. Capital allowance multiplied by the tax rate gives you the tax saving. So the tax rate is 30%. Let me change the color. Just multiply capital allowance with a tax rate, you will get tax savings. So 50,000 multiplied by 30% gives you the tax saving of 15,000, but it is mentioned in the question tax will be paid with a delay of 1 year. So logically, the T1 tax will be paid in T2. So similarly, you will be say since the first tax payment will arise in the second year. So the first tax saving will also arise in the second year. Repeat. It is mentioned in the question that company pays tax with a delay of 1 year. Okay. Since first tax payment will arise in the second year, so that is why. Similarly, the first tax saving will also arise in the second year. 50,000 to 30%, it becomes 15,000. So 37,500 into 30% gives me 11,250. 28,125 into 30% gives us 8,437.5. So 8,438. 34,375 into 30%. It is 10,312.5. So make it 313. So simply, it is since it is mentioned the question tax is paid with a delay of 1 year. So first tax will arise in the second year. So your tax saving will also start from the second year. Now let's see one more question so that you should be try to have a good idea how do we calculate tax saving from capital allowances. Initial investment. It is 2,50,000. Residual value is, let's say, 30,000. Project life 4 years. Company uses 25% written down value for capital allowances. Tax rate is 30%, which is paid in the same year. When we are saying which is paid in the same year, it means no delay. It means T1 tax will be paid in T1. It means first tax saving will arise from T1. Since there's no delay in tax payment. So the first tax payment will arise in the first year. Similarly, the first tax saving will arise in the first year because there's no tax delay required. Calculate tax savings from capital allowances. Calculate tax savings from capital allowances. Assuming investment is made at the start of accounting period. Start of accounting period. Assuming investment is made at the start of accounting period, another very important point, nothing is mentioned. We will always assume that investment is made at the start of accounting period. When we make investment at the end of accounting period, then what change comes, we will discuss that. Don't worry at all, inshallah. But right now, let us stick to this question. Initial investment is 2,50,000, residual value is 30, project life of 4 years. Tax, capital allowance is available, 25% written down value. Tax is paid in the same year. So you just need to make three columns, T1, T2, T3, and T4. No T5, because tax is paid in the same year. Capital allowances. Tax savings. So 2,50,000 into 25%. Let me use the calculator. 2,50,000 into 25%. So the first year capital allowance is coming 62,500. So 2,50,000 into 25% actually gives us 62,500. How do we calculate the capital allowance for the second year? Just take the capital allowance of the first year into 0.75. We are getting 46,875 third year. 46,875 into 0.75. I'm getting 35,156. As I did discuss in the previous question, in the last year, you will always be having a balancing figure. Cost minus residual value is a depreciable cost, and according to IAS 16 property, plant and equipment, depreciable cost must be depreciated within the useful life of the asset. So we have to take a balancing figure. How do we calculate balancing figure? Actually, from 2,20,000, you need to deduct 62,500 minus 46,875 minus 35,156. You will get automatically the balancing figure. 2,20,000 minus 62,500 minus 46,875 minus 35,156. I'm getting a balancing figure 75,469. Let me recheck. 2,20,000 minus 62,500 minus 46,875 minus 35,156. Okay. Since tax is paid in the same year, so capital allowance into tax rate, tax saving will arise from the first year. Reason, because tax is not paid with a delay of 1 year. Tax is paid in the same year. That is why 62,500 into 30% gives you the tax saving in the same year, 18,875. 46,875 into 0.3. It is 14,062. So make it 63. That is 10,547. Okay, 75,469 to 30%. 22,640.7. So make it 1. 75,469. Okay. So dear, so now you should be having a little bit idea how do we calculate tax saving from capital allowances. How do we calculate tax saving from capital allowances? I'm just giving you a little homework. So initial investment is 1,50,000. Residual value is 30,000. Project life is 3 years. Company uses 20% return on value. For tax appreciation, tax appreciation is another name for the capital allowances. Tax is paid with a delay of 1 year. Tax rate is 30%. So company uses 20% return on value. Tax rate is 30%, and tax is paid with a delay of 1 year. Required, calculate. Tax savings from capital allowances. Nothing is mentioned. You will always assume that investment is made at the start of accounting period. Obviously, still you might be thinking, what is the difference if investment is made at the end of accounting period? Let me tell you one thing. 99% questions, in 99% question, you will find the assumption that investment is made at the start of accounting period. What if investment is made at the end of accounting period? We will discuss this in the same question. In part A, assuming investment is made at the start of accounting period. B, assuming investment is made at the end of accounting period. So, dear student, I really want every one of you at least try to attempt part A of this question, where we are making investment at the start of accounting period. So it's just a little homework. Try to attempt this question when we only part A. Inshallah, in the next class, we will be discussing part A and B as well. And inshallah, from the next class onwards, we will start our kit questions as well. And we will strictly follow latest updated BPB kit. So it is equally good BPB and Kaplan kit. Don't worry at all. Using one of them is more than enough to pass the paper. So I'll try my best to cover the kit as much as possible within my lectures. Don't worry at all. So it's a very small homework. I really want you people to try to attempt this question, part A of this question, and inshallah in the next class we'll be discussing part A as well as part B. So thank you very much for watching this lecture. Have a nice life.